Welcome to the Deep Dive.
Hey there.
Today we are really tearing into the Q3 2025 earnings call for Digital Realty Trust, DLR.
Yeah, arguably the biggest name, or certainly one of the most crucial players in that whole data center REIT space.
Absolutely. And our mission today is pretty straightforward, right?
Yeah, we want to synthesize what management said, look at the numbers, and really figure out their core strategy.
Especially how they're pulling off this massive capital plan for AI demand.
While keeping the balance sheet looking solid. That tension, that's the key thing to unpack here, I think.
And the short answer seems to be they're pulling it off extremely well.
Oh, yeah. The market reaction was definitely positive. It really backs up a pretty constructive outlook for them.
The first takeaway for me was this isn't just growth. It's profitable growth combined with serious financial discipline.
Okay, let's hit the numbers that really show that discipline. First up, Core FFO per share, record number, $1.89.
$1.89?
Oh.
What was the street thinking?
Consensus was around $1.79. So yeah, they comfortably beat that. That's 13% year-over-year growth.
Okay, strong FFO beat. And what about revenue?
Revenue also came in around $1.6 billion, roughly 10% growth year-over-year there.
And adjusted EBITDA.
That surged too, up 14% year-over-year to $868 million. Really solid performance across the board.
And you mentioned discipline, the balance sheet side.
Right. This is what's really interesting. They hit these record results, but they also reduced their leverage at the same time.
Okay, how much?
Net debt to adjusted EBITDA, that metric fell to 4.9 times.
4.9x, and their target is what, 5.5x?
Exactly. So they're well below their long-term target.
That's pretty impressive when, you hear about everyone else just piling on debt to build AI capacity.
Right. It feels like DLR is showing up to this AI race with a growth engine that's already kind of paid down its loans.
That operational control, that's got to be what lets them make these big growth moves, right?
Absolutely. Which leads us nicely into that growth. Let's talk leasing.
Okay, the momentum there. What did total bookings look like?
Came in strong. Signed leases representing $201 million in annualized GAAP rent. That's at their 100% share.
So, a big number.
Mm-hmm.
But was it just, the usual hyperscale deals? Or was it broader?
It was actually incredibly broad-based. And this is where you really see the AI story filtering down.
How so?
They had near-record strength in that smaller, high-connectivity segment, the 0 to 1 megawatt plus interconnection category.
Okay, how much did that bring in?
$85 million in new bookings just from that segment.
Wow.
And management specifically called out record AI bookings within that segment. That really signals strong enterprise adoption, not just the giants.
Interesting. So AI isn't just hyperscale data halls anymore.
Apparently not. And the connections are booming too. Interconnection bookings, second consecutive quarterly record.
Okay, how much higher?
Up 13% from the previous quarter's record. And they said it was driven specifically by AI-oriented fiber stuff.
Makes sense. If you've got the compute, you need the pipes to feed it.
Precisely. All this gives them, pretty incredible forward visibility, that backlog number.
Right, the signed deals not yet generating revenue.
Yeah, that grew to $852 million.
Yeah.
Massive number.
And when does that revenue actually hit the books?
That's the key. They said the lion's share is scheduled to commence through the end of 2026.
So basically 2 years of predictable revenue already locked in.
Locked in. High predictability.
Okay, that's visibility. What about pricing power? That tells us about scarcity.
Good point. Blended renewal leases saw an 8.0% cash uplift overall, which is, pretty solid for a REIT.
8% is good, but was there a difference for the bigger deals?
Oh, yeah. This is the key insight, I think. Renewals greater than 1 megawatt. They achieved an exceptional 20% cash releasing spread.
20%.
20%. That's not just inflation. That is pure scarcity premium.
And where are they getting that kind of premium?
In the really tight markets, right? Singapore, Chicago, Northern Virginia, New Jersey. The places where capacity is seriously constrained.
So if you're a big tenant there and your lease is up.
DLR knows you probably don't have many other places to go, at least not quickly. They've got the leverage, and clearly they're using it. And churn stayed low, too, just 1.6% for the quarter.
Okay, that scarcity feeds right into their capital strategy, this whole pruning and planting thing they talked about.
Exactly. They're pruning by selling off some non-core assets, sold stuff in Atlanta, Boston, Miami, and later Dallas.
How much did they get for those?
About $123 million total, roughly.
And planting, where did that cash go?
Immediately redeployed. Straight into buying prime development land in really strategic markets like Chicago and LA.
Adding new capacity potential.
Yeah, adding over 72 megawatts of future IT capacity. So they're essentially swapping out maybe slower growth assets.
Or future high-yield AI-ready capacity.
Right. They're aiming for stabilized returns north of 10% on that new stuff. Smart capital rotation.
Okay, let's connect this directly to the AI mandate then. Management confirmed AI is driving a lot of this, right?
Over 50% of bookings since mid-2023, on average, have been for AI-related uses. So yeah, it's sustained huge demand.
But how are they keeping up? I mean, the scale seems enormous.
Well, they keep emphasizing their inventory. That 5 gigawatts of buildable IT capacity they have globally.
5 gigawatts, that's a staggering number.
It is, but here's what they argue is their crucial competitive moat.
The location.
Exactly. Their capacity, that 5GW, it's mostly situated in these highly connected cloud zonal markets. Think Northern Virginia, Frankfurt, Santa Clara, the core hubs.
Right, and they're really making a point of contrasting that with competitors building these huge campuses way out in the middle of nowhere.
Yeah, those massive sort of latency-tolerant gigawatt campuses where maybe power is cheaper, but connectivity isn't as dense.
Because the argument is that AI needs are shifting.
Precisely. AI training, building the big models, that can handle a bit of delay. It's latency tolerant.
Okay.
But AI inference, actually using the AI for real-time stuff like, assistance or self-driving cars, that's extremely latency sensitive.
Yeah. Like brain surgery, you need zero lag.
Basically, yeah. And DLR's argument is their locations are absolutely essential for that shift towards inference.
And they're building the facilities to handle the power these new chips need. I heard talk of liquid cooling 800-volt architectures.
They are. They're planning for that next-gen hardware. They talked about their HD colo capability.
HD colo, high-density colocation.
Yeah. It's like their supercharged infrastructure setup. Available in 30 metros already. They say it's deployable quickly. And it can support really high-density racks, up to 150 kilowatts per rack.
So future-proofing the key locations.
That seems to be the plan, getting ready for the next wave of hardware.
Okay, but building all this, even with selling assets, it takes serious cash.
Yeah.
How are they funding this 5-gigawatt pipeline?
Right. Big question. Well, first, they have decent liquidity on their own balance sheet, nearly $7 billion.
Okay.
But the bigger piece seems to be private capital. They've arranged something like $15 billion through joint ventures and this new U.S. hyperscale data center fund they launched.
$15 billion through JVs. Okay, but isn't relying that heavily on private capital just sort of masking the debt? Like, are they just becoming a service provider for these big funds?
This is definitely a fair challenge. How much control do they retain versus just managing assets for others?
Right.
But I think the way management frames it, this JV structure lets them speed up capacity delivery dramatically. They can build faster without completely blowing out their own leverage profile, the one they just got down to 4.9x.
So they bring in partners to fund the construction, monetize the capacity through these funds, but keep operational control and, critically, the strategic land.
That seems to be the model, yeah. Leveraging private capital to execute on that huge 5GW land bank faster than they could alone. They expect their own share of CapEx to increase, too, in 2026 to deliver capacity for late 26, early 27, but JVs will fund a broader portion overall.
Okay. So this whole strategy, aggressive AI build-out,
Yeah.
but disciplined finances, using JVs, what does it mean for the investor outlook? Guidance must have been strong.
Very strong. Signaled high confidence. This was their third guidance raise this year.
Third raise already. Okay, what are the new numbers?
New full year 2025 Core FFO per share guidance is $7.32 to $7.38. That's about a 2% bump at the midpoint from the last raise.
And any other guidance changes?
Yeah, they also raised their same capital cash NOI growth assumption, now expecting 4.25% to 4.75%.
Okay, looking solid for 25. What about looking ahead to 2026? Any hints there?
They're targeting 10% top-line growth next year, and they said that's directly supported by the backlog, the $555 million chunk of that $852 million backlog that's scheduled to commence in 2026.
Predictable growth locked in. Are there any headwinds we should mention for 26?
Yeah, the main one is debt refinancing. They've got about $1.3 billion of debt maturing in January 2026.
Okay. What's the rate on that?
It's really low, like 2.5%. So obviously that's going to get refinanced at today's much higher rates.
Yeah.
That'll be a bit of a drag on FFO growth.
Higher interest expense and maybe lower interest income if cash rates fall.
Possibly, yeah. Those are the main puts and takes they mentioned for next year.
Got it. But despite that refinancing headwind, The analyst view is still positive.
Oh yeah, highly constructive. JP Morgan, for example, they raised their price target to $210 after the call.
$210, what was their reasoning?
Basically sold out capacity. They said DLR is essentially booked solid through 2026, which is forcing hyperscalers to talk about 2027 capacity now.
So that scarcity story we talked about, the sell side is fully buying in.
Seems like it. The narrative is definitely landing.
Which brings us nicely to our This Is Not Financial Advices segment.
All right, let's set this up. The core idea here is DLR crushed the quarter, the backlog is huge, guidance is up, but they're still very focused on delivering that next wave of capacity for 2027 and beyond.
Right. And that capacity is going into these increasingly constrained core markets.
Exactly. And that scarcity, especially in those prime metro areas, we think it creates leverage that isn't fully baked into the stock price yet, even around, what, $179 currently?
Yeah, the argument is the market might still be valuing
Yeah.
DLR like a traditional stable REIT.
Rather than seeing it as absolutely essential, maybe even irreplaceable infrastructure for this whole AI revolution. I mean, the supply of power and prime connectivity in these key cities, it's not growing nearly as fast as demand.
It's finite and getting tighter.
So the outrageous but plausible pitch is this. Bet on a pretty rapid step up in valuation. When that next big tranche of capacity from their 5-gigawatt land bank actually starts getting leased out, probably starting for 2027 delivery.
And the bet is it gets leased at those premium rates we saw, that 20% plus uplift.
That's the bet. That hyperscalers get, frankly, desperate for that low latency, highly connected infrastructure in the core markets, and they have to pay up significantly.
Okay, so what's the trade idea specifically? Again, not financial advice.
Absolutely not advice, but the idea could be something like looking at selling deep out of the money puts, or maybe buying long-dated calls.
How long dated?
Maybe looking out quite a way, like June 2027 expiration, for instance. No.
And the thesis is DLR breaks what level?
The idea is that DLR's stock price could break, say, $225 well before mid-2027, as the cloud giants maybe run out of options in the cheaper, further out locations and are forced to overbid for DLR's prime connected real estate.
Betting on that scarcity premium becoming undeniable.
Essentially, yes. Betting that the market re-rates the stock as truly critical infrastructure.
Okay. Let's recap the key takeaways from the actual earnings then.
Sure. So 3 main things for you to remember. First, the record core FFO beat really strong profitability.
Second, that pruning and planting capital strategy seems to be working, rotating capital into high-yield AI capacity effectively.
And third, that massive $852 million backlog, which gives really strong, predictable visibility well into 2026.
All right, and just one more time, this whole discussion, especially that trade idea, is purely for informational purposes.
Absolutely not financial advice. Please do your own research.
So we'll leave you with this final thought to chew on.
Management themselves said these new massive AI campuses being built out in remote areas are latency tolerant. For now.
For now.
Right. But think about that inevitable shift we discussed from AI training towards more real-time AI inference and usage, which needs low latency.
Right.
How quickly will the physical limits, the lack of power, the lack of dense connectivity force the biggest tech companies to maybe abandon those tertiary locations?
And have to come back and overbid for DLR's prime connected 5-gigawatt capacity blocks in the major hubs.
Exactly. That accelerating shift to inference. You could argue it's the ultimate clock ticking in DLR's favor, something to think about.